G'day guys, and welcome to this explainer. So if you've ever walked into a bank here in Australia asking about investing, chances are they pointed you straight towards a term deposit or maybe one of their own managed funds with a nice juicy fee attached. But here's the thing they conveniently leave out. There's a massive secret sitting right there on the ASX that most banks will never actively tell you about, simply because, well, it doesn't make them any money. So, what exactly is your bank hiding from you? It's a classic case of withholding information, really. When you ask for advice, they naturally push their in house stuff. A major, highly effective alternative is kept completely off the table because it just doesn't generate those massive profits for the bank. Today, we're going to shed some serious light on exactly what that alternative is. Part 1: The bank's expensive secret. Let's look at exactly what the bank's financial planners are actually trying to sell you. On one side, we've got the traditional recommendations, right? Your standard term deposits and those high fee in house bank funds that are specifically designed to keep your money firmly locked within their own ecosystem. And on the other side, we've got what we're calling the ASX secret. It's a hidden gem available on the public stock market that offers a completely different approach to building wealth. Throughout this explainer, we're going to contrast these two approaches directly. Part 2: The active fund trap. So, while that financial planner is busy recommending their actively managed fund, they usually gloss over the fact that it comes with a pretty hefty annual fee, usually around 1.5% to 2%. Now, I know that might sound like a tiny percentage at first glance, but here's the kicker. Regardless of whether that fund makes money or loses money, that fee is locked in. It acts as a constant drag, taking a massive bite out of your compounding returns year after year after year. But wait, it actually gets worse. This is the part they definitely aren't telling you in that initial meeting. Study after study shows that over 80% of these expensive, actively managed funds fail to even beat the baseline market average over a 10-year period. Think about that for a second. 80%. Only a tiny 20% actually manage to outperform the market. The mathematical odds are heavily, heavily stacked against you when you use these funds. So the absolute crucial takeaway here is this. You're quite literally paying a premium price for a financial product that historically underperforms. You're shelling out high fees for quote-unquote expertise that, statistically speaking, just doesn't deliver the results to justify the cost. It's wild when you actually break the numbers down. All right, let's pivot to part 3. Enter the index fund. So what is the solution the banks won't actively tell you about? It's called index fund investing, and it's usually done through an ETF, which stands for Exchange Traded Fund. Instead of paying some high-fee manager to try and pick winning stocks and, fail 80% of the time, low-cost ETFs just let you buy the entire market automatically. You aren't trying to beat the market, you're just capturing its natural growth over time, and you're doing it for a fraction of traditional fees. Which brings us to part 4, owning the top 200. This strategy uses low-cost ETFs. Think ticker symbols like VAS or A200. These literally let you own a slice of the top 200 companies in Australia all at once. By doing this, you are instantly diversified across banks, mining companies, healthcare, retail, the whole shebang. And the absolute best part, the management fee for doing this is a tiny, tiny fraction of what the banks charge on their in-house products. You're completely cutting out the expensive middleman. Part 5. Taking back your money. Now, what's really cool is how accessible this is. Instead of sitting through a bank's heavily biased sales pitch, you can just execute this strategy yourself. Step 1. Open an account with a retail broker. We're talking platforms like ComSec, SelfWealth, or Perler. Step 2. Use their search bar to find an ETF, like VAS or A200. And step 3, just click buy. That's it. You can do the whole thing yourself in about 5 minutes.
It's incredibly straightforward and completely bypasses all those traditional advisory hurdles. So, to perfectly summarize our explainer today, essentially, if you go with the bank, you're paying more for a product that historically underperforms something you could literally buy yourself in about 5 minutes. The power to grow your wealth efficiently is right there in the palm of your hand, usually just an app on your smartphone. And it's definitely not locked behind a bank manager's desk where those high fees just eat away at your potential gains.
So, I'll leave you with this final thought to ponder as we wrap up. Armed with this knowledge about index funds, seeing the historical data that shows an 80% failure rate for active managers, and knowing how easy these online brokers are to use, are you really still willing to pay a 2% fee just for the illusion of expertise? Honestly, why would you ever pay bank fees for underperformance again? I hope this explainer has given you some solid clarity on how these financial products actually work. Keep asking questions, guys, and keep learning.